What's going on, everybody? It is Friday, August 6th. We had some surprises today. A big number, big number on the payrolls, up 943,000. I think they were looking for something like 650,000, so that was a huge increase. But by the way, average hourly earnings were down for the third month in a row. The increase was only 11 cents. I think in June it was 12 cents. In May it was 14 cents. In April it was 20 cents. So we've had 3 consecutive months of weaker earnings, weaker wages. All right. But anyway, what happened was the zombies, reacted as they always do. We saw big declines in gold and silver. I think gold was down like 2.5%. Silver was down over 4%. Bonds were down. Bond yields shot up to around the 10-year, I think around 129, 128 something. But again, folks, let's break this down. First of all, strong economic growth is not an automatic condition for higher interest rates. All right, now interest rates are set by the Fed, and they could decide at some point that they're going to raise rates, but that's not going to happen anytime soon. Remember that dot plot? That's the end of 2022. I mean, right now the market is really hyper focused on taper. All right, taper is a reduction in the Fed's asset purchases, which, by the way, I've been saying I don't even think they should be doing that in the first place, because it has created all these problems with massive reserve build in the banking system, and the Fed has had to concoct a whole bunch of like Rube Goldberg structures to alleviate that pressure anyway. So I've been all over that. So here's what happened today, all right? Because of this strong number on the jobs, the probability for an announcement of a taper, not even an actual taper, the probability just that they would announce it went from up to like 22% in November. Okay, so in other words, it went from, I think it was like 12% or 15%. It went up to a 22% probability that they will announce a taper in November, and it went up to a 55% probability that they will announce a taper in December. So I mean, we're dealing with like second derivative, third derivative, fourth derivative here, which is like, it just shows you the insanity and the hyper overreaction we saw in the markets, particularly in precious metals and like bonds. All right, I mean, just an increase in the probability that they would say something in November or December, not even that they would start tapering. Okay, they would just announce like, hey, we're gonna start tapering, I don't know, maybe in January or something like that. So it's getting to the point of like comical ridiculousness. Second of all, economic growth, strong economic growth is not bearish for metals. Okay, metals are still industrial commodities. Gold is an industrial commodity. Silver is an industrial commodity. Strong economic growth is bullish for metals. Now, this is just a sheer, unadulterated, complete zombie reaction when you look at it today. A hyper overreaction. In fact, I tweeted that, I sent it out. Same thing with the dollar. The dollar shot up, right? I mean, you could see this. You could see every single time. And so I'm not surprised. I mean, I was surprised at the number. I did think the number was going to be stronger. Like we saw the ADP number on Wednesday. That was only like, what, 300,000 or 350,000 or something. That was way below forecast, the ADP payrolls. I thought it was going to be in line with the forecast around 650, but we get just under 1 million. And again, I'll just reiterate that average hourly earnings are down. I mean, and the unemployment rate is 5.4%. Like, I really don't see the Fed raising interest rates, and we're not even talking about that. Again, this is not about the Fed raising interest rates, okay? They've been very clear on that. This is the market reacting to a rise in the probability that the Fed will make an announcement about taper in November. I mean, I'm laughing because it's just silly. It's ridiculous. You know, if you think the markets are like rational, if you think like, you know, there's been books and books and books written on, you know, the rational markets and the random walk theory and all that stuff, that the markets incorporate all information and you know, they're perfectly rational and all. I mean, that is such baloney. That is such garbage. Like, I can't even describe how ridiculous that is, okay? I mean, you have people now, like, we're talking about billions and billions of dollars being thrown around because there was a little bit of an increase in the probability that they might say something in November, or that there was a little bit more of an increase in the probability that they might say something in December. Not that they're going to do that thing, but they might talk about it. They might talk about it in November, or they might talk about it in December. So, I mean, if you don't understand like that, you know, you have to go against this kind of stuff. And I'm not saying that when you go against it, like instantly, you know, 5 minutes later or even the next day or the next week, it goes back in your favor. But it does. It does. Because this is just unbridled emotion and nonsense and lack of understanding. And again, I talked about taper, I explained taper. Like, first of all, let's set aside the aspect of, you know, all this reserve addition to the banking system. The Fed buying assets is stripping out income that would have flowed into the economy, right? Through that interest channel. I mean, they're taking out, you know, high quality, the highest quality collateral that there is, U.S. Treasuries. They're taking that out for themselves. You know, I've been all over this. Like, they take it out, then the U.S. Treasury pays the Fed, which the Fed then takes that money and gives it back to the U.S. Treasury. And the whole scheme is like a cockamamie ridiculousness. But taper, $120 billion a month of the highest collateral, the highest quality assets in the world, removed from the economy with the income that would flow into the economy. You know, and people are still talking about that stimulus. I mean, even you know, high-level economists, you know, supposedly high-level economists, you know, would frame that as stimulus when it's absolutely not. I mean, you could see the numbers. You could see the decline in interest payments year over year. I mean, we're down something like 16 billion this year compared to last year because of that interest that has been, you know, taken out that would have flowed into the economy. So it's just completely nonsensical. But again, I mean, what I try to teach you, what I try to impart to you, aside from the MMT and aside from, you know, the mental game, those two very important things, and they give you an edge. If you listen to my podcast, I talk about how that gives you an edge. But the other thing is, like, just at a very basic level, to go against emotion, go against lack of understanding. All right? A strong economy is not bearish for metals, which are industrial commodities. I mean, that's very simple. I mean, the same people who are selling metals today are the ones who have been arguing all along since March, maybe even before March, that the stimulus is inflationary because, you know, you're pumping too much money into the economy. And so now all of a sudden, what, that doesn't apply anymore? Okay, so now they're arguing. See, it's always a different argument. There's no consistency there. Now they're arguing that, oh, but wait a minute. The Fed is maybe going to talk about taper in November. Maybe there's a bigger chance they're going to talk about taper in November. I mean, come on, folks. This is child stuff. This is childish. I mean, this is just not, it's not mature. It's crazy. So yeah, I sold dollars today. I added to my gold positions, okay? Added to silver positions. And we'll see what happens. We'll see what happens. I mean, to me, this was the same thing. Look, between 2015 and 2018, the Fed raised interest rates like, what, 8 or 9 times? And the dollar was lower in 2018. Then we got that ridiculous trade war thing, which pumped the dollar up. And all along, you can go back and watch my videos where I was saying, like, that trade war, not only is it, not really happening, but actually the exact opposite of what the intention was happening. In other words, the U.S. trade deficit got worse. It widened. Okay? Dollar index went up to like 104. Where is it now? 92, 93? Because all of that had to unwind. That was based on an illogical reaction to what the reality was. Okay? It was in people's minds. Oh, a trade war. So what? You think like in a month it would reverse the U.S. trade position? No, we have a record. As a matter of fact, the data that just came out the other day shows we have a record trade deficit. And exchange rates follow that over time. So anyway, it's the weekend. I'm going to go relax. Maybe I'll make a video over the weekend. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trading. See everybody. Bye.